The Hedgeless Horseman here. It's September 19th, 2022. Kind of a volatile day today. The dollar started up and turned down. Market started down, turned up, and the same goes for pretty much most commodities and gold and silver. Like always, I mean, this is just noise, really. I mean, it's extremely hard not to look at it, but it's. I mean, if you have a mature company, for example, what the price of gold and silver is today doesn't matter too much. I mean, the actual value will come when an asset is into production. In the meantime, it's, juniors are, for better or for worse, trading sardines. So we know it affects sentiment, etc. But it's really just a bunch of noise. I mean, when silver is up today, you obviously feel like, hey, maybe this is the bottom, and meaning that I think they're gonna go higher in the next week or month or whatever. But it's like, if tomorrow comes, it goes down, you'll have the exact opposite feeling. Guess, if you had to guess where you think the prices of the equities, mining equities, are going in the short term. It's all a bunch of noise, and we can't help ourselves watch it all the time. But again, that's what everybody else does. Meanwhile, it's like, if you want to do a really simple take or an investing strategy, you should have your buy and sell conditions should match. Otherwise, you don't really have a strategy. So today, if I find it extremely hard to even guess where gold and silver is going in the short term. Okay, so that feels like a fool's errand, or whatever the saying is. What is easier to answer? If you're a value investor, you can look at the juniors and just look at what the company have, what kind of value you think they have, what kind of potential you think they have, what they might be, how many ounces or whatever they might have in the next 1 to 2 years, and then you look at what you're paying for all that. It doesn't take a rocket scientist to see that juniors are incredibly undervalued, and have been increasingly so over the last, 2 years pretty much. I mean, sure, they weren't that cheap at the 2020 high. Some were probably overvalued actually. But since then, it's been a 2-year downtrend pretty much. Regardless if the companies created additional value, kept the value stable, or decreased value, almost everything is down. But it's still quite easy to see that they are cheap. And I'm gonna, like the boy who cried wolf, if they become even cheaper, even more undervalued, there's only one rational thing to do if your buy condition is buy when they are cheap. If they become even cheaper, it's the easiest thing in the world to know what you should do. But if you're like most people, like 90+% of people, who they buy and sell based on what they think the asset they're buying is going to do in the next week or month or so, I have no idea. Macro is incredibly hard, trading is incredibly hard. To spot something cheap right now is like, again, that's not rocket science. That's why I think it's the by far most superior way to go about it. Especially since if you actually have a value investing approach, you automatically become a contrarian. You automatically will stick around for the bottom, because it makes no sense that if you bought something because it was cheap, if it got cheaper, what kind of value investing strategy would have you sell out when the opportunity got even better? There isn't one. But if you're a momentum trader like almost everyone else, or trying to guess what the weather is going to be tomorrow or next week, whatever, it's like, first of all, it's very hard to do, and it's very hard to get right, and that's not really a strategy, and it's mostly based on how we feel about any particular asset on any particular day. I mean, today, for example, nothing at all really happened probably with most juniors to change their valuations, but I see some are up 30%, I see some down 16%, So what gives? It's all I mean, it's Mr. Market doing its things. Some other points I just want to touch on. It's like now, like I said in I think the last video, the focus has been you know, the dollar, fear the dollar, yada yada yada. And that's what, again, what everybody is focusing on. What is the dollar gonna do? And people, you know, waiting to see if, you know, waiting to see a dollar top. And now that we went down, I think on Thursday in gold and silver, immediately people were screaming $1,400 gold, here we come. You know, predictable, because it, I guess it kind of, you know, broke for a period of time below this level or whatever. It's like, yeah, that's pretty obvious, first of all, that this is a, you know, major support thing. And it's like everybody's looking at this. Everybody's drawing comparisons to 2013. You know, you have a horizontal support here, horizontal support here, and now it's just at the edge. I mean, everybody can see this. This is obvious to everyone, including gold bugs, etc. It's like, but when I think about it, okay, right now, I don't remember exactly what happened. I mean, things were bad, obviously, in the world. We had a European crisis, or that might actually be more a 2011 thing. But I think there was some meeting between the banks and yada yada yada, and then they killed gold and following Monday or something, and obviously started a stampede momentum, and that's what everybody fears right now. But it's like, when you look at the COT reports, for example, I mean, they look like they should look around the bottom, and the sentiment is awful, bloody awful. So I don't really see where this fuel is gonna come from. That's gonna have, you know, we enter let's say a new bear market, or we're entering a cascade selling shortly. I just don't see it. It's like physical demand is up, gold and silver from COMEX is going out of the walls. Lowest levels in silver on, I think, at least in the registered category since like 2018. The COT the commercials, I think, in silver are like net long. I think it's in silver or gold, which they haven't been since like this time and this time. So obviously everything like that signals sentiment, positioning, demand. I think silver and gold has been in backwardation. I think there's a higher price in East. So everything, almost every like fundamental aspect is signaling that gold is undervalued. Sure, that might change, but I don't really see that's like the underlying fundamentals. Gold hasn't, well, it's been on a ramp lately, but the sentiment is nothing compared to what it was 2011, as far as I understand. So and again, it's like, if you want to, let's say, paint the tape, I mean, again, this almost looks like a, you know, repeat of this, but it might simply be too goddamn obvious. And who knows, maybe this was a fake out and this is actually the low. And on that point, it's like when we think about risk reward, the juniors are already, many are down like 80%, at least 60%, 60 to let's say 90%. They are already down that much. So it's like, where are the risks? I mean, if a bunch of juniors are pricing in $1,400 gold, what are you really afraid of? I mean, if gold goes down, maybe juniors will actually go down like 50% more or something to, you know, absurd levels where they're going to go up 1,000, 2,000, 3,000% or whatever. But if this is actually a fake out, etc., and they're already starting off pricing in $1,400 gold, you can, you know, the upside is pretty obvious. And who knows, let's say gold goes down and maybe, you know, juniors start to, let's say you wait for $1,400 gold and juniors and miners bottom before that. I mean, look at, well, not this, here for example, 2011, 2012 top. Miners, this is GDXJ. Miners topped here 266 days before gold topped. And you can see the divergence. Like, yeah, gold made a lower high, some months later. GDX was slaughtered during that time. So I mean, the funny thing is, like, gold went from here to here, while that's up quite a bit. GDXJ went down here. That was before the crash in gold. So juniors, or GDXJ at least, topped and turned on a hurry way before, or decent amount of time before gold went down, and it actually started crashing kinda, way before gold started to crash. So it's like, again, I'm just trying to highlight the fact that even if a theoretical scenario happens, you don't even know what how the market is gonna react to it. Because if you had someone from the future said that gold is gonna peak around here, and gold was here, and you're like, yeah, miners have gone up, but I mean, gold is gonna go put in a blow off top, so it's like, yeah, it's gonna go up several percent. Of course I'm buying. You would still have the wrong result. Even if you could foresee the exact movements of gold, you would have lost money. So it's like, that's what's so hard about macro and trading, etc. Whereas to have a simple strategy, like, okay, am I overpaying or underpaying for something? That's a lot easier. It doesn't care at all about how the chart looks, or what do you think an investor is going to do, it yada yada yada, or what if this happens, what if is Fed going to pivot, is Fed going to raise rates, when is the full moon, when is the Kardashians coming back on their show, reruns of Kardashians. I mean, there's 1 million things you could guess, in terms of input factors to your analysis. What are the rates going to be? What's the real rate going to be? What happens to inflation? It's like, I have no idea. And there's millions of people trying to guess that every day. While I try to to have if you're supposed to be able to follow a strategy, I think the simplest strategy is the best, and that's simply and one of those is value investing. Is this worth more than I'm paying for it? Is this worth less than I'm paying for it? In that case, sell or don't buy that. That's it. Like right now, there's crystal clear that juniors are cheap. Crystal clear. If that's your only buy condition, I want to buy something that is undervalued and the risks are to the upside, and it's not typically on average, at least, a matter of if, but when they're going to go higher, because we know there are two certainties: the price you pay and the sentiment always changes. So if we're at an extreme low and they are undervalued, they're gonna swing higher one day. When is the last time sentiment never changed? Never. Sentiment always changes. Another factor, or another point, perceived risk is not the same thing as risk. When prices are low, perceived risk is high, but actual investment risk is lower. I mean, you've heard Rick Rule say this all the time, and Warren Buffett, yada yada. My question was, is it risky to buy something worth $100 for $25 just because the stock chart looks horrible? That's again just to point out about being a contrarian. Do I feel brave or a contrarian right now? If I'm when I'm still increasingly so trying to get more into this sector, get more money into this sector? No. Why? I mean, is it brave to buy something that is like stupid cheap and only a moron would sell? I don't see that as brave. I don't feel like a contrarian. I feel like a common sensarian, because I think this is quite common sense. You have projects out there, like good projects with good people, or at least decent, people, whatever. We have a, supply problem in pretty much every commodity, and some juniors out there are selling for like, I don't know, 10-20% of the net present value, even in tier 1 jurisdictions, after, you know, some are being down 90% from the 2020 top. Is that brave, or is that just, again, it's like outrageously obvious that they are cheap? I don't feel brave at all. I feel like a kid on Christmas nowadays. Like, I was watching the Beaver Creek presentations. I had flashbacks from, I think, 2015-16 when I watched some Beaver Creek, and I was just, you know, looking at all these juniors and couldn't believe my eyes how cheap they were. That was around the time when I got into this sector, and I just bought and bought and bought and bought as much as I could, because you know, you could see it. Okay, the economic study says these juniors are worth somewhere around this much, and you're buying them for like 75% off. It's like, again, you don't need to be a contrarian for that, or a rocket scientist. It's just unbelievably obvious that these are buying opportunities. And some other points. I mean, we know inflation. I you know, most of the time, I don't typically trade much, or, you know, buy and sell a lot. At least not recently, because there, I mean, there's almost nothing I own that I see as a clear sell. Otherwise, I would obviously have sold it. But there's so many no-brainer buys out there, I think. I mean, not that every project is a tier 1 project, but just from like a sentiment and trading perspective, or playing the beta. I mean, we don't see valuations like this too often. Maybe it happens every 10 years or so. So that's why I'm like a kid on Christmas. It's just unbelievable. And I wish I had, you know, 1000% more money to put in right now. Anyway, we know, when you think about, like, okay, what's happening out there? There's inflation, cost inflation, you know, reagents, labor, many base metals, yada yada yada. So again, okay, for an investor, it's like, okay, given that is an issue in this current environment we live in, how can you play that? I mean, how can you take advantage of that? What is going up in value and what is going down in value? I would say that sunk costs are increasingly going up in value. Because let's say a mill, if that was built 3 years ago, it would cost like, I don't know, 30-40% more today. And if inflation continues like this, maybe the cost of that mill, or you know, well, anything really, you know, permitting studies or economic studies or whatever, it's like, if that's going up in price 10% per year, if you can find juniors that have already done that, or, you know, have those sunk costs in place, I mean, you're stealing something that's already there and getting pricier and pricier. So I mean, if you are about to build a mill, that's probably going to cost you much more today than 2 years ago, and maybe even more 2 years from now than today. So in a time where it's like capital is kind of hard to come by for many juniors, meaning that, okay, it's even harder to get the money for stuff. If that said stuff is also going up in price, obviously the winner in that scenario is the junior that already has those things in place. And that goes for, I mean, drilling costs are probably up quite a bit as well, you know, labor and fuel and what have you. Permits, I mean, permits take years to get, probably cost some tens of millions of dollars if you're going, you know, PEA, PFS, feasibility study, environmental permits, and anything in between. So we're talking like, from an inflationary standpoint, you know, sunk costs probably up many percent. Permits cost a lot of money, increasingly so, I would assume, and a lot of time. And I mean, that's why I have come to like conclusion now that when, especially very recently, I think we have gotten so low in sentiment and valuations across the board that, like I said, I think it was in the last K report or 2K report interviews ago, that I'm looking more and more on beta, like strict value investing, because my bread and butter for the last, let's say, 2 years has been focus on alpha, and I don't ever think that's a bad idea to focus on, you know, the internal value creators. With that said, when we're reaching these extremes, a lot of the advanced explorers and developers are looking increasingly cheap. I mean, mind-numbingly cheap. There are some juniors out there that are cashed up, have a resource, have a PA, maybe a PFS, maybe some permits, maybe some infrastructure. They're selling on their in light of their enterprise value. They're valued less, for sure, less than their sunk costs. Meaning, it would, if you would want to get to the stage that they are, you would have to pay a lot more money and wait, you know, years for that progress to come about. And you can buy that for cheaper than it would cost to redo that, and you would also need to be incredibly lucky. So, okay, I guess, in my opinion right now, early stage explorers are cheap. I mean, they are really, really cheap. Almost everything is cheap. But I think the relative risk reward in advanced explorers and developers are nearing, well, they've gone down so much as well that I think they are better buys based on risk reward now than most early stage explorers. So I'm thinking, okay, first of all, I don't think world-class exploration targets, that's like, you know, they are so unique and so valuable that I don't think you can ever go wrong with that. I don't think you can ever go wrong with that, because they will have such abnormally high value per ounce, or it might be abnormally large of a deposit, etc. But almost no junior is going to find a world-class deposit. Take you know, Snowline Gold, for example. That might be abnormally large, and abnormally large for such a system, reduced intrusion related gold system, and it might be abnormally high grade for such a system, and it's in a tier 1 jurisdiction. You don't come by that very often. Majors don't come by that very often. So those types of stories, I think you can never really, there's never a bad time for them. Let's just put it like that. Never a really bad time for that, because they are going to be so unique. Their value could be so unique. But instead of buying early stage explorers right now across the board, when we consider the fact that 98% will not really find anything of value, and if they find something, it will probably be tier 3 or lower in terms of a deposit, especially at least in the foreseeable future. But if you can buy tier 3 projects right now, tier 3 or lower, maybe some tier 2 projects as well, for way less, or at least for less than it would cost to actually get to that stage, to prove that up. I mean, think about how much value you're stealing in that case. You're not even rolling the dice if they are one of the very few that would find a tier 3 project. Not only did they find it, but you could buy them after the fact, after they proved that up, maybe have some permits in place, maybe some infrastructure in place, and you're paying less than it actually cost even to get there. So that's not even the, you know, risk-adjusted value. You're getting a discount on reality, on what is confirmed. This is why I love this sector, because it's so incredibly stupid sometimes. It does not make sense at all. if these valuations out there make sense, they would reflect basically a mining sector where like gold deposits are easy to find and there's no problem getting more supply and there's almost no demand, because they are reflecting a world where the gold mining business is not totally worthless, but almost. And that is simply not the case, because there are not many big discoveries made in the last 10-20 years. There are not many mines that get built, especially in this day and age of ESG. The cost of building them are going up, hence why sunk costs are going up as well. So I've been looking around. I haven't really dabbled in the advanced explorers or the developer space, because like I've said before, I prefer not to be forced to gamble on timing, etc. It's like, let's say we're here. I have no idea if gold or silver is gonna go up. I have no idea if this downtrend here in miners were gonna kick off. So I was prepared always for the worst, and I wanted to buy the juniors that I think could affect their own fate as much as possible, meaning if they can just keep on growing, I'm gonna get bailed out one of these days. Because if the sentiment continues to do poorly, sure, I'll probably be down, but down less than the ones that are just mature and just follow the price of gold and silver. With that said, when we find ourselves here, I mean, back here, you couldn't have known that we were gonna hit this level. And it's incredibly hard to time and predict prices. And I see, on that note, I see people all the time, especially recently, talk about the opportunity cost. Oh, there's been such an opportunity cost in miners. That's what they keep telling themselves. Like, opportunity cost is a thing where you in hindsight just conclude that, well, hey, these assets went down, so there was opportunity cost. It's like, no shit, Sherlock. When are you not going to have opportunity cost unless you are literally all the time positioning something that goes like this? Everything on Earth almost had opportunity cost, if you look at it that way, when Dogecoin was going up 3,000%. But was that an opportunity to begin with? Opportunity and opportunity cost is in the present moment. You can't look and say the opportunity cost was, because you didn't know that. Opportunity is everything you can do with your money invested in any given moment. So today the opportunity cost is anything we can do with our money except buying juniors right here and right now. And if we look at the last like 14 years, it's like the opportunity cost is, in my opinion, very high in a lot of other stuff relative to juniors. So the opportunity cost right now is low, simply because it's that cheap. So since we don't know what the future is going to bring, we can't just all the time conclude it's been opportunity cost, because that's why, like now, for example, people proclaim you can't make money in juniors. So I'm getting out of this sector. Why? Because they have seen this. They got in around here and saw this, and they say, well, you can't make money in this sector. That's a dead sector. Whereas, people with some common sense is like, the only thing, in hindsight, everything is clear. Of course, I would have wanted to sell here and go all in here. So sell out at the next top. So I only saw this all the time in my portfolio. But you can forget about perfect trading. That's like, everybody tries to do that all the time. I find it like incredibly fascinating that people that I know for sure probably not gonna beat the market, they're out there giving their advice all the time, how the importance of like timing and to get it right and not be in the wrong sector or whatever. It's like, Uh, on that note, this is a graph for Pilbara Minerals. It's a lithium play. I remember it was quite hot back in 2000, I think 17, 18. I think lithium did pretty well that back then as well, and then the lithium sector cooled off. Okay, so like consider this. When this topped in 2018, it went down 50%, which is more than most people can bear. Then it went down 50% again, and then it went down 60% more. That's how much pain you got in the lithium sector, pretty much. So if you have a strict like rule, like some people say that if you're down 50%, everybody calls you a bag holder or whatever, that you're an idiot. What does that tell you? I mean, that's obviously like an ego thing. People like to point out other people's quote mistakes because it makes them feel better about themselves. Where in like reality, if you bought here and went down 60%, in hindsight, if I hadn't shown these percentages, if you saw this chart and someone say, "Yeah, I bought back here," you would have said, "Wow, nice, great timing. I mean, incredible. Wow, you picked it up almost at the perfect time." Yeah, what would people say if at this point in time? Some guy buys here, says it's down 60%. I bet he would be ridiculed and be called stupid or whatever. Maybe that got him to sell because he was thinking, "Hey, if I'm down 60%, there's no way that I'm doing something that is right. I must be making a mistake. My investing strategy must be poor because I'm down 60%." And probably again, feeling a bit ashamed, perhaps, hearing how stupid it is, might have sold here and given away a 3,620% return. So I would argue that this is probably very cheap, and it still went down 60% more than the final turn. And think about it in another way. The action people dream about is if we just pretended that this chart here just kept going like this black line. A never-ending, relentless climb higher. That's what people dream about. Because if you ever sit through a 50% correction in anything, people will say that that's bad. You made a mistake. Even though the actually great investors like Warren Buffett says that, or I think it's Charlie Munger, his partner, says that if you can't stomach a 50% retracement or more in your portfolio, you don't even deserve to have good returns. So when you listen to everybody on Twitter or the forums, they call people idiots for being down 50%. Meanwhile, the best investors in the world say you don't deserve great returns if you can't stomach a 50% retracement. And I promise you, the ones that say you can't have a 50% loss or more and still be doing a good job, they are the ones who don't really beat the market, because they think you need perfection and you need to trade every turn. That's simply not true. That is simply not true. And you can hear that from the absolute best and richest billionaires in the world. And especially in a sector like this. I mean, I think you really should have a rule of thumb. When you start to think that a sector in the commodity cyclical space is getting cheap, you should not be surprised at all if it goes down 50% from where you purchase it. Because this is such an irrational sector that it will undershoot big time on the downside, and typically, I don't know if this is actually overvalued, but it can very much overshoot on the upside as well, like 2016. First Majestic was pricing in a way higher silver price than the current silver price. So you were paying a speculative premium. You were overpaying for the present based on a future that very positive future that has yet to come. So that was overpaying and a speculative premium. Now we're not even paying for the current price of gold. Some units are already pricing in a $1,400 price of gold. That is a very favorable environment to be a buyer, because the risk reward is so absurdly skewed to the upside. But that does not mean that, like in Pilbara Minerals, for example, they can fall 50%, then 50% again, and then 60%. But in hindsight, when these cycles play out, this looks really smart right now. This looked like incredibly smart, and still you had to, if you bought here and sat just through this downside here, you would have been down 80%, and you thought you were buying low, and you would have been down 80% before it turned around, and you would have made bank on this buy here. Because when the sector turned, it went up a lot. And another point which I pointed out before, no trend lasts forever. Sure, this is one stock and any stock can go bankrupt. But if we pretend this is the lithium sector, for example, or any commodity sector really, the longer a downtrend persists, by definition the closer we are to the next upturn. And the longer a rally persists, the closer we are to the next downturn. That's just by definition, because of, again, no trend lasts forever, has never will, without big corrections on the way. A bull follows a bear and a bear follows a bull. That's just how it is. So when you think about it, assuming that value of juniors in, for example, gold has not collapsed as price has, so the cheaper and the longer a correction runs, and the cheaper the price. I mean, you're really getting a double whammy, because if you could have bought here or here, of course you don't really know that the downtrend was over. But what we know is that this was 2020 June. Okay, like. Almost a year, okay, a bit less than a year. But anyway, it's like, even though you didn't know that this would turn out to be the bottom, if you bought here, that was still 1 year longer into the correction, which means that it was 1 year closer to the uptrend, and thus 1 year closer to whatever sentiment top, whenever that's going to come. If the sentiment top was here or here or here, this is still in time, in compounding, in a compounding perspective, you get quicker returns. And the lower it goes as well, you get obviously higher returns. The cheaper something goes, the like you can see on these percentages here, the future returns go up exponentially. That's why it's like when you see the gold junior sector right now, for example, the longer this goes on, the longer the downtrend persists, the closer we get to the next bull, and the cheaper they get relative to value, the more you're gonna make. So not only when you continue to average down in good juniors, as they get cheaper, the returns you're gonna get from those juniors is going up exponentially. And for every day that passes, you're gonna get quicker returns as well, regardless of when the actual bull comes. So this is like the absolutely most costliest mistake you can do in all of investing, is to sell low and late. Because again, this was the lowest point in this whole graph here. And this was much lowest point, meaning highest future returns. And this point is closer to the sentiment top than this was. This was 2018, 2020. So like 2 years later. So a purchase here would have you wait 2017, let's say 5 years. 5 years to get a good return, very good return, 287%. 5 years for 286%. If you bought here, 2 years later, it's like, 3 years for 3,620% return. That is just an astounding difference. Not only the shortened time frame to said returns, which affects compounding, obviously. It's like, it's obviously a lot better to get 50% every 6 months than 50% every year. You're gonna compound at a way higher rate. But you also get higher returns. I don't know where we are in the gold sector, but what I do know is that sentiment always changes. So let's say this is a medium sentiment high. So the lower it goes, the higher the difference is, obviously, the higher the future returns are. And the longer it takes, the closer we get to this next sentiment high. So it's like the delta in time decreases the longer a correction goes on, and the lower it goes, the higher the delta in price goes, meaning future returns. So it's like, I'm just saying, basically I'm saying, which I've said countless times, there is nothing on earth that is more costly to do than sell late and low. There is nothing costlier, because the returns are going exponential. And when you consider the fact that time is also shortened to the next high, whenever that is, that means not only are returns going exponential, you have to multiply that by the shortened time frame. So it's like, a multiplier effect. It's just absurd how expensive it was to sell down here. If you sold here, you were giving away, I don't know exactly, but let's say 50% return in 2 years. That's still good. Down here you were giving away, 600% return in like 8 months. So this sell here is multiples worse than this sell here. And by definition then, of course, a buy here is multiples better than any buy before that. Because this is, the longer it takes, closer to the next uptrend, and the lower it goes, the higher, the more returns you will have in the uptrend. So it's like, I am tied to the mass. There is no way on earth that I'm selling here, regardless of what the chart of gold looks like, what everybody says about real rates, what Fed is going to do, what the ECB is going to do, what if there's a full moon out, what the Kardashians think about gold, yada, yada, yada. Right now, and that does not change the fact that it can still get worse, like we've seen in Pilbara minerals. If it's already down like 80%, it can still get worse. But that just means it becomes an even more no-brainer buy. And if you're not already tired of me screaming buy all the way, especially like, I thought it was cheap here already. I'm gonna be screaming buy, to whatever, maybe it turns today, tomorrow, maybe it turns here, I don't know. But if it goes lower, that means the correction will have lasted even longer, and the price to value gap is probably going to be even higher, especially the price to the price delta to the next sentiment high. So again, selling just becomes worse and worse, and buying becomes just exponentially better, ×2. The longer this takes and the lower it goes. So when you think about it, it's like, in the Pilbara minerals, for example, you can have like 5% of your portfolio left at this point. And if you didn't sell and rode this all the way to this point here, you would have a very good return actually. So, okay, how do you greatly increase your future returns? Buying, obviously. I mean, again, if you bought the top only, you went all in, didn't make a single buy, and in this case, I mean, in a pure trading sardine, if you went all in here, you're not really gonna make any money from this point to this point, which is like 4 years. That's why it's like you have to have some kind of timing or a sense of price to value in trading sardines. This is more of a alpha story, obviously, and lithium really kicked off. But it's like, again, people dream about this return, but you would have made a lot more money if let's say you bought in for 10,000 here and bought for 1,000 every 2 months or so. You would it would look really nice. Your portfolio would be going up every single day, and your any purchase you made would be in the green the following day, and for the next couple of years. So you would feel like the absolute king. Everybody would say, Jesus, you are lucky or whatever, good, etc. And you would feel like the master of the universe, because you couldn't lose. Your portfolio only went up in a literally straight line. However, and people would say this would be an absolute curse to see your portfolio down, I don't know, 93% before it went up, or the stock down 93% before it went up. But if you compare the person that went all in here and purchased every 2 months up to today, if you compare his returns versus a person that went all in here and then added $1,000 extra every 2 months, and so bought every way down, and didn't even buy more at the lows, just kept on buying every 2 months. This person who had to sit through a minus 92% retracement would immensely outperform the person that bought all the way up and never really had a down day. So this is, like I said before, this is the kind of price, the stock action that people dream about. This type of action is what you get dream returns from, as long as you're not, dumb and sell out at the lows, but increasingly buy. So again, you can consider, what do you think I'm doing right now, and increasingly so. Do you think I'm more inclined to sell down here than I was here? Most people would rather sell down here than here, because they weren't that, discouraged by the price action back here. But after 2 years of negative action, when they believe that there's nothing on earth that could change this trend, they sell out. Most people sell out. They can't stand looking wrong for such a long time. They can't stand, they don't want to talk about investing, because they don't want to tell people that, hey, my portfolio is down 60% or whatever in the last 2 years. They feel ashamed. They just want to get away from it. Whereas the people that actually are kind of rational about, it's like, okay, I thought this was low, but now it's just getting ridiculous. It's like, Jesus, I'm gonna make a fortune when this turns. I mean, it's so obvious what you should do. It's so obvious, but I don't think it's obvious to most people, because they are not actual investors. They are just momentum chasers, and they think that everyone that's sitting on a big paper loss is an idiot. Whereas, again, like Charlie Munger, who says that if you can stomach a 50% retracement or more, you don't deserve great returns. So basically he's saying it's a requirement for great returns to be able to sit through minimum 50% corrections now and then. And in a sentiment-driven and cyclical space like commodities, you should probably notch that up to like minus 70% or something. I haven't reached minus 70% personally, but this is my fourth minus 50% decline. And again, like always, maybe you can reshuffle your portfolio at any point in time. It's like, let's say you have one story that did really well and it's actually held up. And you see stuff you had watched for some time but never really got around buying because you didn't think they were that cheap. Now you look around in the space and you're like, constantly going through your watch list, and now you realize that, hey, I mean, there's some juniors here that I wasn't prepared to buy because I thought they were overvalued. They're down like 90% now. It's like, honestly, you don't, if, yeah, I don't think if you're down 70% in your total portfolio, and I mean, yeah, in your total portfolio, I don't think that's even going to be a real problem when this turns. If you're down 70% in total. And typically, I mean, if you're down, it's like I have big retracements, but they're from higher levels. Because my investment journey is not buying in here and selling out here. I have made above average picks and been fully deployed from every bottom so far. That's how I can afford these flushes, because I don't own only Bear Creek Mining, for example, that pretty much only ping pongs up and down, like up 500%, down 80%, up 500%, down 80%. But when the opportunities present themselves, so there's like, I'm looking at some advanced explorers and developers which I weren't interested in buying until like the last month or so. Opportunities come to us. That is opportunity cost. The opportunity cost is at any given moment, and right now I have the option to buy and sell any stock there is. All of those are hands I could theoretically play. So at this very point in time, right here, maybe some juniors are suddenly a great opportunity, but they weren't a great opportunity 3 months ago, for example, relative to some other companies. But now maybe the opportunities have switched, that, okay, things that I thought weren't real great opportunities, then they have gotten more punished than some others, which I own perhaps. So then I have obviously the option to shift out of something I thought was a better buy 3 months ago, let's say, to something that was a worse buy 3 months ago, but a better buy today. Because things have changed. There's been 3 months of price action, and maybe some got punished more. So it's like, now is not the time to be totally... Well, first of all, I think you don't really need to be that much of a stock picker. It's just that that's a way to up your expected returns, to still be like, don't go on vacation and forget about it just because the portfolio sucks. I mean, you could be minus 70% right now, and you could buy stuff that's down 70%. But if they are on average better stories than the ones you held, you're gonna make more money, even though you're down the exact amount right now, because investing has nothing to do with the past. Investing has all to do with the future. So I have no real problem selling something that's, let's say I'm selling something I'm down 50% on. But I'm buying something that's down 60%, and I actually think it has a higher price to value gap as well than what I sold. In that case, I sold an opportunity, took a permanent loss for 50%, bought something that was even more undervalued, where let's say it's down, 60%. So I'm thinking, okay, I'm selling something that I think might go up 200% after being down 50%. But I bought something for that money that I think will go up 300%, and it's down 60% right now. I made, quote, made 100% in expected returns simply from buying something that I'm down a lot in and buying something that's simply a better opportunity. So you can shuffle around quite a bit, and again, like I've said, during these extreme lows, the future returns go bananas. Let's say you had two Bear Creek minings, two different Bear Creek mines. This is actually Bear Creek Mining 1. Note, I don't own Bear Creek Mining, so this is just an example. Let's just say there was pretty much an identical story. Let's say there were three identical stories, actually. Three different Bear Creek Mining type scenarios. You owned all three. And one was trading right here, one was trading here, one was trading here. Your expected return was the difference from current price to this level here, let's say. In that case, let's say this is actually A. That's Bear Creek A, this is Bear Creek B. This is Bear Creek C. Okay, let's say you owned all three of them, and they had all of them had traded the exact same way that B, the actual Bear Creek Mining, down to this point, but then one went up in price. B here stayed put, so it just flatlined. And C here went down to this level. In that case, the future expected return for A would be 434%. For B, it would be 597% and 830% for C. So if you sold A, you were giving away a 441% return and would be investing in something with an expected future return, let's say 100%. So just from identical stories, let's say, you're both down a lot on all three, but let's say you at least sold everything you had in A to pick up C. You just netted a 400% return on that that money. Future expected return. So even though you're down 60%, let's say, on this one was down, I don't know, 75%. Let's say you're down 80% on this. Yeah, 80%. And you bought this. This would net you a 830% return, and you would obviously, in that case, make all the money back if your 1,000 invested had turned to 20,000 to 2,000 in A, but you bought C with an average return of 830. Because let's just simple math, 9.3 times 2,000, 18,600. So your 10,000 invested, let's say you invested here, would actually turn to 18,600. So you would have netted a 86% return, which is good even if it took like 4 years. Literally, I mean that would actually be good. So how could you boost that? That's obviously, that's if you like went all in here in all these three stocks. So it's like from an even if you pick an extreme example in this case, you would still you still could make it work as long as you didn't sell down here but actually bought the ones that were the absolute cheapest. Just from switching from A to C, which had the same value but different price levels, so different price to value gaps. And since the future expected returns go so exponential when we get to these extremely lows, you completely transforms the future return of your portfolio returns. You could have sat idle in all three, and let's say everyone actually went back to this level, so you would have made it out with a net return of 0, because all went down 80%, or let's say 85% here for C, and then went back up. But just from actually using the opportunity to buy something, sell something that you were deep in the red in and buy something that was even more undervalued, you just boosted your future portfolio returns. So just keep that in mind. It's like, yeah, I hope I'm getting through with my concepts here, that it is extremely critical to your future returns what you do at these sentiment levels, what you do at these extremely low prices. And again, you don't need perfection. This is Patriot Battery Metals. Obviously they made a discovery in lithium is hot, whatever, but like, look at this short here, down 89%. And from this level it went down first 34%, then 51%, and then 68%. So it like went down 90%, then down 90% more. Holy hell. Still. Now in hindsight they made a discovery and the market turned around for lithium, etc. You could actually have bought here and you would be up 662%. But you would first have to suffer through a 34% correction, followed by a 51% lower, and then 70% lower. 68% lower, I mean. So basically, when the timing thing, you could have bought all the way through here and you would still have a very good return. Even higher. It's like something like that. This is a log chart, mind you. But you would also have looked like a complete idiot to 95% of people for years. For years. Absolutely. Let's say again, it's like, oh Jesus, down 90%. Then it fell even more. So you look like an even more idiot. And that went down 51% more. And then 68% down to this. So it's like, if you can't look absurdly wrong with a lot of buys, I don't think it's gonna be easy at all to actually make money, because it's like, it's almost impossible not to look stupid during the lows. And most people will try to convince you that you need timing, that like everybody else is waiting for the exact bottom. And I just ask myself, like, how do you know when that is? Again, it's like, yeah, okay, this looked like a breakout here, so you missed this whole move, and then you bought here, and then wham, down again. Or this one, I thought this looked like a bottom because we reached, kind of extreme sentiment already. So let's say you bought in here, it's like bam. Instead of just buying all the way down, sure, you bought on the way up as well, but it's like buying just more the lower it goes. So it's like, the idea that you can't be down 50% is just bullshit. Absolute bullshit, especially in commodity sectors. I mean, again, like I've shown countless examples, you can be down 50%, down 50% again, and then 60% again. And now we know that if you bought the top, that would still work out. And obviously, the more they went down, the more you should have bought, and that's just how it goes. If it's a good story, a case is intact and it's ridiculously cheap, if that goes down 50% and you're down 70%, that doesn't change the fact that it's just an even better buy. And that doesn't mean that you made a mistake, because there's absolute no way that you could know that this, for example, was going to go down 60% more. So you can't know that. If you're even in the ballpark of a bottom. I mean, if you bought all the way through these areas, just that as long as you especially bought increasingly so, you could have bought all the way through this period. It looked wrong for years. This was kind of short, so it was actually a bit easier, I think. I think not in Great Bear Creek perhaps, but like, you don't even need to be very good in terms of timing. It's just that the best weapon you have is the ability to buy the lower it goes. Because again, a small add down here is gonna contribute an immense what's the saying? Anyway, it's like a small buy down here might, it's gonna have a, let's say, 610% return. I mean, if you added a 5% here, or just lowered your average, like here, for example, in the Pilbara, if you bought all the way down here, and you had an average of, what is this, like 64 cents, this would net you 667% in, like, I don't know, 3 years. Whereas this would give you, at best, a 287% return. So if you just sat through this whole ordeal, 2 years, and the share price that went minus 93% or something, if you just bought through the entire nightmare period, when it became incredibly cheap to the point of outrageously cheap, you would have way better returns than the person that never saw a retracement, just as long as you're willing to buy the cheaper it gets. The problem of always buying high does not get fixed by selling low. It gets fixed by being able to increasingly buy low. If juniors continue and fall 30% from these levels, you should by now understand that if they were brain dead cheap and they fall 30%, that's beyond brain dead cheap. The future expected returns go exponential. So you don't even need to have, I mean, if we get really extreme, you don't really need to have much left of your portfolio actually, and you're still gonna make it out. Okay, because if you just continue to add that, the best weapon, the best defense and offense you can have is the ability to buy cheap and cheaper. That's my I think that's my strongest trait. There is no way I am selling cheap. And I can buy as low as, I hope to be able to buy lower than anyone else, basically. Because then I'm going to outperform absolutely everyone else. Yeah, long rant. Thanks for listening. Hit the like button if you like this stuff. Don't invest money you cannot afford to lose. Obviously, don't invest money you will need in the short term, because there's nothing worse than buying here when it is actually cheap, but being forced to sell when, the money would be even better spent sitting put, because then you just were forced to permanent a loss. So yeah, I mean, typically you don't want to do that. Thanks for listening. Bye.